And it's time now for the Wall Street Beat. Bond traders are boosting wagers that the Fed is about to signal deeper interest rate cuts next year than the market anticipates. Wall Street is preparing for a potential rate pause in January. We're going to talk about those implications on private markets and public credit markets with Marathon Asset Management CEO Bruce Richards. You have still inflation above the Fed's target, yet the market is expecting another cut. What does that mean to you in terms of the trajectory of inflation going into a bigger easing cycle ahead, even if that easing cycle is less than initially expected?
Hi, Sonali. Great question to open with. So 43 straight months, core CPI is above 3%. 43 straight months is rather remarkable. We haven't seen a stretch like this in a really long time. In the last 3 months, 3.3% is the number. And so the Fed, Powell won't tell us this, but they've given up on 2%. They've given up on 2 because they know the number's 3, and they know tariffs are coming, and so that's going to keep it firm. They know pro-economic policies are coming, less regulation, and so that's going to keep it firm. They know it's not going back down to 2. They can't tell us that. So what they're going to tell us in today's Fed meeting is they're cutting rates 25 basis points. And so from September 18th to December 18th today, exactly 3 months, they will have reduced rates 100 basis points. Probably a bit much given growth is above 3% this quarter, GDP expected by the Fed, and given where inflation is. And so I think we'll see the dot plot go from 4 today, where it was previously, to 3. Next year you have 8 meetings. There's only going to be 2, maybe 3 cuts next year. And so most of the time they're going to be in pause, and that's going to keep the markets anxious next year because most of the times they won't be easing, and the markets really like to see an ease.
So what does this mean in terms of the trajectory of inflation next year? If you're a fixed income investor, inflation is killer. And so do you expect that it's going to be higher than anticipated? And do you fear, like some investors do, of a 70s style repeat?
I believe that the R-star, the real rate of rates is going to be higher. The nominal rate's going to be higher. The Fed has lowered rates after today 100 basis points, yet the 10-year note's gone up 75 basis points. And so the markets, the bond markets, aren't believing the Fed's language as it relates to inflation. They take what the Fed gives them in terms of the Fed easing. Equity markets love it. Debt markets love it. It's great for the economy, but real rates are higher.
Well, I think that's so interesting. You mentioned, of course, at 2 p.m. today, we'll have had 100 basis points of easing. The long end has just been, it's been shocking to see that move. And, you talk through the reasoning why it could be happening. But what does it mean for other asset classes? When does the equity market wake up to the fact that the long end is saying, hello, look at the trajectory of where things are going?
Well, the first thing it means is, and we haven't seen front rates come down 50 or 100 basis points and long rates go up by 50 to 100 basis points. We haven't seen this dynamic since 1990s. It's not happened since then. And what happened then was the economy was strong. That's why rates were going up. Yet the Fed was easing. And so what happened? Credit spreads went to their tightest levels ever. This is investment grade, triple Bs, double Bs, high yield, all to their tightest levels ever. So what we're going to, and it stayed there for a year and a half.
Yeah.
So what we're going to see, the first knock on, is the economy's doing well, earnings are doing well, and so corporate credit spreads are going to tighten in, but yet you can earn a 7% in liquid markets in both high yield and other structured credit instruments that are non-investment grade. And so it's a good rate, but yet it's a really tight spread because the credit risk is being mitigated now.
Well, that's what's happening now, right? I mean, you have credit spreads across the spectrum at very, very tight levels. And you put it all together, you could make a case for backing up the truck on investment grade and on junk. Are you making that case?
Well, we've been buying and we'll continue to buy, and I think that you'll have a low volatility environment for those types of assets. And so do you want to back up the truck now? I think you want to be equal weight now, but I think that within your kind of fixed income allocation, you want a nice, healthy allocation because I think the risk factors are down. The risk factors being credit risk, and you're getting paid an average yield despite what's a tight spread.
So how do you invest through all of this at the end of the day? This is the setup. You believe that the rate is higher at the end of the day. You are seeing that divergence that you haven't seen since the 90s. What do you do with that?
Well, first of all, I think it starts, Sonali, with the 60-40 model, right? And And the 60-40 model is alive and well, and it's how every investor, whether you're a wealth investor in high net worth or whether you're an institutional investor, should think about investing, the 60-40 model. And so within the 60, that's equities, and that's public equities, and that's how we think about it traditionally. But public equities have just had back-to-back years of 25% plus gains. You've only had that twice in the 90s and the 1950s. And so it's probably not going to be repeated next year because we brought forward, some of this price action. And so I think this is the time where you want to say, okay, equities will make a 7% return, our historical return, and we'll really want to lean into private equity. And so think about public and private equity for the 60% model is how you want to think about that.
Bruce, we only have time for one more question left here, but you said this thing in the commercial break that I really want to get to. You told us you think Basel III Endgame is dead. You think that has serious implications for credit markets. Your conversations with the banks right now, bring us inside of them and what that says about where the direction is going.
I do believe that Basel III Endgame is dead because I believe part of the regulations that we're going to see, the regulatory relief that we're going to see, is going to also transform into what's happening in the banking system. Rather than have these onerous rules placed yet on the banks, I think the conversations that Jamie Dimon and Donald Trump and other people in the administration, incoming administration, have with the bankers, will lead to that. And I know the Fed and Vice Chairman Barr has a lot to say about this, but I believe it's dead. And so what that means, it means the CET1 ratios of the banks, which are pretty strong and pretty large, it's going to unleash a lot of ability for the banks to be able to lend. The number one place they're going to lend to is they'll lend across the board, but they'll lend loan on loan. And so folks like Marathon will get really attractive financing from the banking system, and that attractive financing in the form of lower rates that we're going to be borrowing at will help drive our private credit returns. And so the 40 model, getting back to 60-40, is not only 40% fixed income, but half of that should be in private credit. Direct lending, we're seeing twice the deal flow that we're seeing today, now, this past quarter, than we did in the whole last year. And asset-based lending is alive and well and taking off in a big way. And having that financing available from the banks is a big boon to all of us in the private credit markets.